I'm going to be looking now at question 3, which is Lyria. Again, make sure you've spent some time breaking down the requirements and doing your own plan before you listen to this debrief. The first part of the question was in 3 parts and worth 13 marks. So, as a starting point, you could say, well, if there are 3 parts, 3 fours are 12, so it's like 3 4-mark or 4 and a bit mark questions. You can't judge it exactly, can you? But that might help us to make sure that we're allocating time. The first thing that we were asked, again, in respect of a football stadium, they're planning to sell it and then lease it back. The first issue is whether that football stadium can be held for sale. This again is not specialist knowledge at SBR. It's something that you met when you studied financial reporting. Those financial reporting standards are so important. So as always, start with your knowledge. And then of course the knowledge is that you would want to explain held for sale, but you can put down the various criteria. One of the key ones, of course, is that the sale is highly probable within 12 months of the year end. Now, in this particular case, when you come to apply that, the SOFP date, the balance sheet date, I think is October 05. The planned sale is November 06. That's playing a bit dirty, isn't it? But that's 13 months. So it's not held for sale. You could have an argument at another level as well. Because this is a sale and lease back, is something that being sold and then leased back in substance, is it a sale or not? So you could have an argument about that if you wanted to. Personally, I'd just stick to very basic knowledge, as I always do. The second issue were some improvements to the crowd barriers. So when you actually pay someone to put up new crowd barriers in the stadium, they're tangible assets. When you pay Bill and Ben to erect the barriers, you'll debit PPE and credit cash. Are you supposed to do anything before then? No. There's no legal obligation to do it, so it's nothing to do with provisions. There's nothing to suggest that there's been an impairment, so they shouldn't really be doing anything whatsoever. It might be that I'm planning to replace my window next year. Again, do I do anything about it now? No. So actually there should be no double entry just because they intend to replace the barriers. So what they've done is just completely incorrect. They've charged profit and loss, and they shouldn't have. So in this case, as you can see here, that the company has done this, it's unnecessary. So there is no impairment indicator. There's no legal or constructive obligation to replace or to fit the barriers. No legal or constructive obligation to install the barriers. So why on earth are you processing some double entry? You might be planning to travel next year and go on holiday. Is there a double entry for that? No. When you go, you'll pay the airline, and that's when double entry bookkeeping comes into the fore. So therefore, again, the client entry in their books should be reversed. So they have debited P&L and credited the PPE. So we would have to debit the PPE and credit P&L with the 2 million. Don't forget, if your debits and credits are rusty, you don't have to use the word debit and credit. You can just use words increase and decrease. So if you're saying PPE will increase, profit will increase, that's perfectly okay. I guess a lot of the good marks here are for talking about the next part, which is the sale and lease back. When you discuss sale and lease back, the first question is you have to decide whether there is actually a sale. So step one is to say, is there a sale? Is there a transfer of risks and rewards from the seller to the buyer? Look at the scenario. The life of the stadium is a long period. The lease is for a shorter period. So essentially, once the lease is over, then the stadium is someone else's problem. So I am actually selling it and then renting it back for a short period of time. That's probably what determines that there is a sale. So I think I would say there that there appears to be a sale. What I would look for in scenarios is the fact that the lease term is less than the asset life. There's nothing about us repurchasing the stadium back. If there had not been a sale, for example, if we had transferred it and then rented it back for its whole life, it would just be dealt with as a secured loan. So I think there is a sale. Lease term is less than asset life. Therefore, and then of course step two is then to account for the sale and lease back. So we need to account for the transaction. Try not to immerse yourself in the numbers at first. The big message, isn't it, is that if we have got a sale and lease back, I'm going to de-recognise the PPE and recognise instead a right of use asset. So in this situation, what I need to explain is that I will de-recognise PPE. Remember, that's how we say take it out of the books. Instead of the PPE, I will recognise a right of use asset and also a lease liability. You could present it as a journal once you've done the explanations. Probably, again, if you don't like the journal, you can say up and down, but I wouldn't write the journal straight away. Again, it may well be that your numbers don't tie up with the answer. It doesn't matter as long as they can see that you've got the spirit of the transaction. So when we have a sale and lease back, what's the impact on the books? It's really a five-limbed journal. So when I'm booking this, if we just talk this through, you will debit or increase cash with 30. That's an easy number, isn't it? So the cash is definitely coming in as 30. I will also recognize this new right of use asset. On the other side, I'll be crediting a lease liability. I'll also be crediting the PPE because the PPE is coming out and something else is going in. And then there'll be a balancing figure, which could be a debit or a credit, a profit and loss figure, in respect of the bit of the asset, the PPE that we have effectively again sold. That profit and loss figure will always be a balancing figure. So essentially, whatever your numbers are, just let the P&L be the balance. The lease liability, you're looking for word about the present value of the lease payments. Look for anything that says present value of lease payments. That's the lease liability. It might say present value of future lease payments, but you're looking for words like that. In the scenario, we're told that the present value of the lease payments, again, is expected to be 26. So we can see that number, if you look back in the scenario, again, so it's around 4 or 5 lines down. So there we are, the present value of the lease payments. That's 26. Now, these two numbers go together like Harry and Barry. When you do the right of use asset, you need to take the present value of those future lease payments, divide it by the fair value of the asset, and multiply by the carrying amount of the asset. And the PPE down here, of course, is the carrying amount of the asset. Now we know the present value of the lease payments, again, is 26. We're told that the cash proceeds are equal to the fair value of the asset, so we know that. So the only problem is the carrying amount. In the printed answer, they've done things that we wouldn't probably have thought of. You see, you can't really use the 18 because we've already said that that's understated by 2. So maybe you managed to use 20. But even then, that's not right because that's the figure 13 months before this transaction. So it's a horrible calculation. I think they come out as 18.92. I'm going to get this slightly wrong deliberately and say, well, let's assume that I'm in a panic and all I'm going to do is just use the 18. I'll say, well, I don't know quite how to get to this other number. So again, I've taken the 18. It's not quite right. But at least if I've used that, then I can carry on, can't I? And I can say 26/30ths of 18 is whatever it is. Let's just work that out. There we are. I'll use 15.6. And then the balancing figure, whatever it happens to be, I think I've got 1.6. It won't agree with the answer, but it's finished and I've explained things and I am calm. So don't worry if your number is not precise. The main thing is, have you explained the 2 steps? decide whether there's a sale. If there is no sale, it would have just been a straightforward secured loan in other words. And secondly, account for the transaction. We say goodbye to the PPE, bye-bye, and hello to the right of use asset, hello. There we are. There's the first 30 marks of that question. The remaining 12 marks of the question, a couple of points there. It was principally to do with acquiring football players. Again, it's testing our basic knowledge of intangibles. So if you buy a football player as a football club, then of course their contract, what you pay for, is recognised as an intangible asset and will be amortised over its life. So 2 parts to the question. The first part said, well, it was about the amortization policy, wasn't it, in respect of those intangibles. And we're asked to compare what the company does and also what the industry does. What the company does is to match the cost against the related revenues. So effectively, again, the costs are matched against the expected revenues. So if you get, again, if you're expecting a lot of revenue from Ronaldo in the first few years, you'd recognise a greater cost. The industry policy is something that sounds a bit duller to me. The industry policy, again, would be, I suppose, a more straightforward method of amortization. But the industry policy, again, is to simply amortize over life. So amortize over useful life. So if Ronaldo is expected to last 4 years, spread it over 4 years. Is our policy acceptable? Yes. Is the industry policy acceptable? Yes. The prize winner will probably know that there's a rebuttable presumption in the standard that suggests straight line. No need to use it. You can rebut it and say, well, I think that's a bit silly. Personally, I think the company policy is pretty sensible. So it's simply saying, look at those policies. Would they be acceptable in applying the straightforward matching concept? In the remainder of the question, we are then asked, again, to comment on players' contract costs, impairment, and CGUs. So the second part is very much about the players. First of all, the contract costs. So I'm buying David Beckham. He's probably stopped playing by now, but I still remember Bobby Charlton. But I'm buying David Beckham. I'm paying 50 million now. I might have to pay more in the future. Well, is that all part of the cost of the intangible? Yes. And use the standard recognition rules, which says if you're probably going to have to pay something, recognise it. If you're possibly going to have to pay it, disclose it. You've learnt like basic things like when you have an aircraft, you have the cost of the engine and then how you depreciate it. this isn't an engine, it's a person, isn't it? The contract, it's intangible, but the principles are exactly, again, are exactly the same. So, again, the key thing is there that when the contract is signed, we would have to consider the likely outcome of these extra costs if they're probable. Again, capitalise. If they're possible, disclose. Capitalise, again, just remember, means add to the cost of the non-current asset. So I could have used the word recognise. So it's just a little bit of an explanation around there. I think it talks as well about renegotiation. You know, just as you have a refurbishment of an aircraft engine, you can probably refurbish David Beckham. When you do that, again, it will be a cost and it will get capitalised. It asks us to think about impairment in the context of these intangible assets, these football players. And of course the message is, isn't it, that if they unfortunately injure themselves, fall over, well, we won't get too picky about it, but they fall over, they're damaged, they can't play anymore. What's the word for it? Well, they've got some kind of career-threatening injury. That would be an impairment indicator. So again, if they had a significant injury, that would be an impairment indicator. So think back to, your regular standard there on impairment. So in that case, you would need to write them down to recoverable amount. Poor things, with a charge in the profit and loss account. So write down to recoverable amount. Again, there'll be a charge in the P&L. I don't think they'd have a value in use anymore unless they just stood outside the ground selling programs. I'm sure that was very tasteless and I'm sorry. But again, certainly words like fair value, less cost to sell. Except that would probably be nothing as well. I guess it would be nil. But we'll leave that aside. And the other thing they asked us to debate, wasn't there, is a single player a cash generating unit? You might say, I don't know anything about football, which I don't actually, but you might be saying you don't know anything, and you say, I don't know. Use the basic knowledge. The basic knowledge, isn't it, is that a cash generating unit is something that generates an independent stream of income. So when you go to see Manchester United or Torquay United or wherever, are you just going for that player or are you going to see the team? I suspect you're going to see the team. You're not going to shout the rest of the team, get off, get off. So I'd have thought an individual player on their own is not a CGU. So essentially, football, and we all know this, is a team sport. You have to have the team. Again, a single player is unlikely to be a CGU. There we go. That's question 3 in that exam.